Ladies and gentlemen, good day and welcome to Q4 and FY'25 Sandhar Technologies Limited's earnings conference call, hosted by Emkay Global Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chirag Jain from Emkay Global Financial Services Limited. Thank you, and over to you, sir.
Thank you, Amshad. Good morning, everyone. On behalf of Emkay Global Financial Services, I would like to welcome you all to the Q4 and FY'25 earnings conference call of Sandhar Technologies Limited. Today we have with us from the management team, Mr. Jayant Davar, Chairman, Managing Director and CEO, and Mr. Yashpal Jain, Chief Financial Officer and Company Secretary. We will begin the call with opening comments from the management team, followed by Q&A session. Over to you, sir.
All right. Good morning, ladies and gentlemen. Let me welcome you all to the quarter 4 and 12 months earnings call of Sandhar Technologies Limited. I want to thank Emkay Global for putting this together. On the call with me from our company is my colleague, Mr. Yashpal Jain, who is the CFO. To begin the call, let me talk about how the world is for us, for our sector. You are aware of the geopolitical situations and what kind of challenges they are bringing to the world. The automotive world on a global level is surely facing headwinds and with a lot of uncertainty because of the tariffs and so on and so forth, as well as insecurity on the part of a lot of the population. There has been a little bit of a drag on the auto sector. And I do believe that both the United States and the EU will continue to have some turbulence in not just this year, but in the continuing years as well. You have seen marquee brands like Tesla and all also face challenges in the sales, and also the quick ramp up of several competitors who entered the field of non-IC engines to bring up competition. So where India is concerned, I do believe that India is comparatively stable, and we are seeing a decent demand, and we do expect that the industry, as most are saying, will continue to grow in high single digits even in this year. As per Sandhar is concerned, Sandhar, under the circumstances of what I have mentioned above, has continued to perform well, and we have achieved a total income growth of 11% compared to quarter 4 2024 and 10% compared to full year of financial year 2024 at a consolidated level. We anticipate sustaining this growth momentum. Of course, it is subject to geopolitical conditions, market demand, the performance of the auto sector and other related factors. The India business for us has achieved a growth of 13% compared to quarter 4 of financial year 24 and 13% growth according to the full year of financial year 2024. The consolidated EBITDA grew by 9% in quarter 4 to 109 crores versus 100 crores and grew by 14% year on year in financial year 2024 to get to 400 crores of EBITDA in 25 versus 351 in financial year 24. The EBITDA for India business grew by 12% in quarter 4 25, which is 97 crores versus 86 crores, and grew by 21% in 24-25, which is 357 crores in 25 versus 294 crores in 2024. I am also very pleased to share that all our joint ventures are experiencing strong growth and consistently improving performance. Further, pleased to share that all our joint ventures are PAT positive in quarter 4 and for the full year financial year 2025. The success is driven by focused cost control, localization efforts, enhanced business synergy. We remain confident that this growth trajectory will continue and grow. Collectively, our joint ventures have recorded a total income of 303 crores with an average EBITDA close to 13%. We are also thrilled to announce that Sandhar Ascast Private Limited, our wholly owned subsidiary, has successfully acquired the high pressure and low pressure aluminium die casting business of Sundaram Clayton Limited at their Hosur plant for a total consideration of 163 crores. This strategic acquisition marks a significant milestone in our growth journey, allowing us to diversify our operations and enhance our manufacturing capability. By integrating Sundaram Clayton's legacy with our expertise, we are poised to drive innovation and expand our product portfolio, tapping into the new markets. We took over the operations on the 1st of April 2025. For us, the key benefits of this acquisition include entry into the low pressure die casting market, enhanced production capacity with higher tonnage machines, broadened product offerings, including essential components for automotive and industrial applications. We are excited to welcome the talented team from Sundaram Clayton and look forward to achieving new heights together. On the overseas business, the performance of the overseas business has been a drag for us in Q4 as well as for the full year of operations. We sustained losses marred by low demand and slowdown in Europe. We are closely watching the situation over there, and as per preliminary indicators, the volumes should increase in financial year 2026, not so much from the growth in Europe, but from the addition in the wallet share of the components that we have. The company's expansion projects in Pune for cabins and fabrication and die casted are expected to commence commercial production by the end of March 2025. Should start to happen now. Our EV business has started commercial production of battery chargers and is getting a very positive response from the market. The customer base is gradually increasing with more and more customers added. With that, I will conclude my opening remarks. And in fact, I should also mention here that that's a question that we've been having from all of you for a long time is the smart locks. You would be happy to know that Sandhar Technologies received the EV Best Part Development Award from Suzuki Motorcycle during their annual supplier meet. Now, this particular product line is ramping up, and we do expect a gradual but sure-footed growth in this particular year. On the CSR front, we've dedicated ourselves to sustainable business practices that address economic, environment, and social challenges. Our efforts go beyond just business concerns. We want to create a positive impact on the communities that we serve. So we are focused on diversity and equal opportunities. As we go forward, our focus areas working towards ESG and SDGs, diversification of product portfolio, expanding customer base, and increasing content per vehicle, which we've been doing, improvement on ROCE and ROI, consolidation of operations, and generation of more free cash flows and deleveraging of our balance sheet. Those are the agenda items and KRAs for us that we must continue to improve and achieve as we go forward. With that, thank you all once again. We are open to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Tushar Gupta from Sagun Capital. Please go ahead.
Hello, sir. Am I audible?
Yes, you're audible.
Yeah.
Go ahead.
Yeah, you're audible. Thank you for the opportunity and congratulations for good set of numbers. Sir, I want to know about what are the capex plan for the financial year 2026 and what is the market for EV charger? How much we can expect a revenue from this segment?
So the CapEx plans for 25-26, largely like we have a CapEx policy in case like that it is equal to a depreciation at the group level. So from the normal, the maintenance CapEx and the growth CapEx, we are expecting around close to 180 to 200 crores in this financial year, 25-26.
Okay. And sir, how much large this EV charger and controller market can be, and how much revenue we can expect from this segment?
Tushar, to just give you this, we have a 3-year plan for the EV business. This will be the first full year of operations where we have targeted numbers which are comparatively smaller in the range of between 10 to 15 crores, but it's ramping up very quickly to a 100 crore level within the next 3 years.
Sir, one more thing. What if, like we have acquired a Sundram die-casting unit, so how much we can expect from that? Revenue, potential and all.
Yashpal, you want to give the numbers?
Yeah, sure. So like Sundram Clayton, we have acquired the ongoing business on a slump sale basis. And this year we are expecting a revenue of around 400 to in between 425 crores. This is the revenue expectation from that business, and it is again subject to the demands in Indian market as well as the overseas market because it's highly dependent on the customer schedules also. But we are expecting this revenue to range between 400 to 425 crores. And it has a, I would say, potential to grow further. But yes, that has to be seen in the coming years. And ideally, we maintain a asset turn ratio of 2.5 to 3 times in long run. So we would like to achieve it going forward in the next 2 to 3 years of time.
Okay, sir. Sir, one more thing. Like as we see in Q4, we have increased the margin, EBITDA margin. So it can be going forward or it can be stable. It will be stable. So, please highlight.
Yeah. So in last 2 to 3 years, in the calls we have been emphasizing that we are on the task of improving our EBITDA margins also, as well as the earnings before tax also, including the ROCs. So you can expect another improvement of 30 to 40 point basis in this FY'25-26. But I think that is the upper level that a component industry can achieve given the market situation. So 30 to 40% we are expecting a healthy improvement in EBITDA in FY'25-26.
Okay, sir. Thank you.
Thank you. Before we take the next question, we would like to remind the participants to press star and 1 to ask a question. The next question is from the line of Saket Kapoor from Kapoor & Co. Please go ahead.
Namaskar, sir, and thank you for the opportunity. So just to reiterate of what you mentioned in terms of the EBITDA margin trajectory, can you specify what I missed your number for? You mentioned some 30-40%. Can you come again?
No. Yeah. We expect an improvement of 30 bis to 40 bis, means 0.3 to 0.4% in EBITDA margin FY'25-26. But again, that is dependent, as you know, on the industry challenges also and the demand pattern also.
Correct, sir. And sir, in terms of the Sundram unit acquisition, sir, what are the current metrics for the unit in terms of the revenue and the profitability?
So like as we mentioned in the filing, currently the unit was operating close to a revenue of 390 crores something, or I think 376 crores, because it keeps on fluctuating. But for this financial year 25-26, we are expecting a revenue fall of around 400 to in between 425 crores. The reason is that we have started the operations in their premises, but during the intermittent period during the financial year, we will be shifting the entire operations to our own premises. So that's the reason, considering all those factors and little bit disruptions, we expect our revenue to between 400 to 425 crores. But in long term, as you know, we keep our financial metrics that any business should deliver a asset turn of 2 to 3 times, 2.5 to 3 times largely. So in next 2 to 3 years, we would like to scale up to those levels.
Okay. And what are the current margins and the profitability for the unit, if you could mention, sir?
So largely it is with the die casting like a single higher digit or at the most 9.5 to 10% is the, I mean, in the ADC segment, 9 to 10% is a healthy margin if one can achieve. So I don't think anything would be changed. That would continue.
Right. And since we are in the first... Yeah, please. Please, no, sir, you continue.
No, that's what I was saying. Because we are not seeking to expand on a larger capex base. That's the reason we are more focusing on improving the return on capital employed once the investments are through. So largely the EBITDA change remains between 9 to 10% in ADC. That is also a very good EBITDA margin, one should say.
And sir, even we have disposed of one of the unit, correct me there. So if you could just explain the rationale for that. We did sell one of our units during this interim period only.
So you are referring to one of the residential lands or exit of joint venture? Can you elaborate further?
Joint venture, and yes, sir, I'm referring to the joint venture.
Yeah, so there was one of our old joint ventures, Jinyong Sandhar Mechatronics. So the expectation with which we formed this joint venture with our Korean partners and the level of activities were not up to the mark, and we are reviewing our JVs also in the sense that we want to scale up the business. And the Jinyong has been, I would say, financially and operationally not performing well in the last 5 to 6 years. So there was a serious talk within the organization also, and management was of the view that the long-term objectives of our organization as a Sandhar might not be fulfilled while continuing the joint venture. So we plan to exit the joint venture.
Okay. And sir, when we look at the console numbers, although there is a significant increase in terms of the revenue profile, but the margins and the contribution to the profitability is flat, as you have already alluded in your opening remarks. So if you could just give us some more understanding on how at a consolidated level, especially the margins are going to shape up. I just wanted to highlight a point that on a revenue top line of 1,014 crore, we post PBT of 50 crore for the consolidation, whereas in the standalone on a revenue, I think it's 700, just a second, sir. On a top line of 758, the profitability is 50 crore. So the PBT number moves up by 5 crore on an increase in the top line by 220 to 5 or 240 crore. So if you could just explain the dilution of margins when we go on consolidation and what steps, because in your opening remarks, you did mention that our targets are to improve the margins at both the standalone and the consolidated levels, and all steps are being in the angle to achieve that. So if you could just throw some more light on this.
Yes, sure. So basically in the opening remarks, if you remember, our MDs also mentioned that the European business has been a big drag for us during the financial year 24-25. So if we compare the growth between the Indian subsidiaries and the foreign subsidiaries, the Indian subsidiaries have outperformed. Basically, we have large subsidiary at Sandhar Engineering, which is into the sheet metal business. And for the last 3 years, we have set up 3 manufacturing greenfield projects in the same. Now, all those have started, the revenue started flowing in, I would say, the right direction, and the business has ramped up. The major drag has come from the European business. So we have sustained our annual loss of close to 21 crores in the European business. Otherwise, rest all other joint this Indian subsidiaries, they are performing very well. They have already crossed the break-even levels, and in the coming, this financial year 25-26, they will be posting healthy margins also. As far as European subsidiaries are concerned, we are reworking out our strategy over there, because as you know, the demand is sluggish in the overseas market, whether it's the US or the European markets, and there's a lot of confusion is also prevailing with respect to the tariffs and how the business deals will be happening between Europe and America, per se the Asian countries. So, in a bid to revise the operations, we are taking some strategic calls, and we are expecting that FY'26, 25-26, we would not be facing this much of losses in the overseas business, and our first task is to ramp up the operations over there and to cut down the losses in overseas business. So this is how the strategy is there. Otherwise, the Indian subsidiaries, they are performing very well, and they will continue to perform.
last point, and I joined the queue. Sir, firstly, in terms of, I think the closing capital work in progress balance at the standalone and the Concall level. So what are the new capacities that will get commissioned during the year? And also, on a conservative outlook, also on a top line of, say, 3,900 crores, which we posted last year, what should be the stable rate of growth in the top line? You did add it to what margins would look like, the trajectory. So what should be the top line trajectory, sir, which we may guide through for this current financial year?
So the capital work in progress largely is 113 crores is on account of the advance that we paid to Sandhar as a part of first tranche of payment as per the business transfer agreement. So 113 crores is comprised of that, which we have already discussed that business will be generating a revenue of 400 to 425 crores. Because we bought this business for 163 crores and 113 was paid prior to 28th of March. And remaining was 50 crores for discharge prior to 11th of April. So this is how the major CWIP is being routed. Remaining CWIP is on account of the other two, I would say the Pune projects of CFD and aluminum die casting, which MD sir has also mentioned. Now they have, the commissioning has been done and the commercial production will start within this quarter. So they will be adding up, but in the first year, the ADC and this cabins and fabrication being a heavy industry, it takes 2 to 3 years to ramp up the production. So there would be addition to the revenue, but that would be close to around 40-50 crores in this first year. As far as the top line projections are concerned, auto industry, as ICRA and other agencies have issued the report, would be a high single digit growth only. But we expect that we might be landing a growth of not lesser than what we have done in the last year. With the new business and plans adding up, I think we can land something around 14-15% of the top line growth in the coming, with the same stable growth in the auto industry in India that we project.
Yes. Thank you, sir. I'll join the queue for my follow-up. Thank you.
Thank you.
Thank you. The next question is from the line of Resham Jain from DSP Asset Managers. Please go ahead.
Hi, good morning, Dawaji. So just on the overseas piece, we have spoken about it, but given that it is taking slightly longer and obviously it can test anyone's patience, but from the strategy perspective, over the next 2 years, 3 years, what are the kind of guardrails you are keeping for that business? Because somehow the recovery is not coming there, and the overall debt also is significantly higher. The net debt to EBITDA of the overseas business is also on a higher side. So how do you see the overall restructuring? What are the 3-4 important steps you are planning to take there to improve the overall profile of the business?
Resham, thank you for that question. I know it's been a thorn in the side for a while now, but just to brief you on what we've been doing. What we've been doing is that we've been replacing higher cost capital. We've added more businesses and more products in that particular business, and the effects of that have already started to show. So if you even look at the last quarter was much lesser losses compared to the previous quarters. And we do believe that with the improvement that is happening, that started to happen in the last quarter, that improvement will continue and we will be able to mitigate the losses that we have. On a long-term basis to 3-year basis, our capacities in Romania, which got delayed because of the war, are now being utilized. Mexico had gone down on account of confusions with the US and other things, are back in operation. So from a perspective of regular operational strategy, we do believe that the losses that occurred will be mitigated to a large extent in the year 25-26. Where the future is concerned, you are aware that we have a lot of strategic advantages of having this business, and this is the reason why we could manage to get the business in India, and with now this new Sundaram Clayton acquisition, we are amongst the top few players in the country from being nowhere at one point of time. and this is on account of the specialized componentry that we do. So we are hopeful that strategic stay in our kitty has helped us, and our job is to make sure that we not only mitigate the losses but affect it into profits. You are aware that the EBITDA margins in our overseas business was actually higher than our India business. And we are hopeful that beginning from the next quarter itself, you will see a huge amount of change coming in terms of positive direction. Yashpal, you want to add something?
Sure. So as far as said, we are expecting the business to revamp in the coming 2 to 3 years of time. We are in the process of preparing long-term plans. Also, if you remember, in India also 2 years back, we were struggling with the same margins, but we have taken many efforts and steps towards improving our margin base also and going with the healthy product line. The same we would be mapping to overseas operations also. And I think the FY'25-26 won't see the losses to those quantum which we have seen in FY'24-25. And soon the operations will be back on the track.
Okay. Thank you, sir, for giving that confidence. So that's the first one. The second is on the overall revenue. We have touched almost 3,900 crores this year. And given that you have acquired a new business plus several new wins, how do you see the overall revenue panning out for FY'26? Broad numbers?
So, the industry, as we have seen the reports, is a single large digit growth, right? But still, we are expecting that 15% or some growth should come up in our revenues. Rest we will be working because the customer schedules keep on changing every quarter. So large depend on third and fourth quarter. But still, basis the stable growth in the industry, we are expecting a healthy growth of 14 to 15% in the revenue. But our more focus will be on improving the margin base. So, more focus on the margin base.
So just to clarify, this 15% is without 425 crores of Sundram Clayton, right?
Yeah, you can expect that.
Okay, understood. Okay, thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Preet from InCred AMC. Please go ahead.
Thank you for the opportunity. I would like to ask about the debt level. In previous con calls, you mentioned that you will be keeping your debt levels below 700 crores. And now, obviously, for the acquisition purpose, you have to take the debt, and the debt levels have gone beyond that. Do you have anything, the peak debt, how much you can go, or will you be further increasing that, or it will be now staying constant at this level?
So, on March 25 at console level, we have a net debt of 740 crores, right? And largely, which includes a payment of 113 crores in the last week of the March to Sundram Clayton as an advance to the purchase consideration. So, majority of the acquisition price we already factored in March 25. Another 50 crores has been factored in April 25. And I think the debt level should not go beyond what we have seen the gross debt levels of 850 crores in the month of March at one point of time. Because we will be generating EBITDA, as I have told in the previous question and answer session, that 30 to 40 bits we are expecting an improvement in EBITDA, and this year we have closed at EBITDA of 399.79 crores on a round side, it is 400 crores. So again, with a 15% around growth in turnover, we will be having the healthy inflows of cash from operations, which we would be using for our expansion needs, and we won't be relying on a higher debt levels for our organic, as far as organic expansion and organic operations are concerned. If something inorganic comes up, then that would be again backed by the revenue of that business. So that I am not factoring right now.
Okay, got it. And one more question from my side. What would be your outlook? What do you expect from the subsidiary business in the coming year? Will it be able to reach the break even? And if not, then in which year you expect the subsidiary to come back to the break even levels at least?
So Indian subsidiaries have already crossed the break-even level because Sandhar Engineering was the new subsidiary that we floated in 21 FY'21, I mean 21-22. So that has already crossed the break-even. It was a sheet metal, 3 units were installed in the company. As far as overseas is concerned, as we have discussed, just before this call also, we are working on improving the operational efficiencies and the margin base in overseas. And I think this year, by the end of this year, we should be very near to the break-even in overseas business.
Okay. And how much do you expect from JV? Similar profit levels which we have seen in FY'25, or it will be improved further?
So largely the JVs, the operations have stabilized because initially most of the JVs were formed during COVID. That's the reason they were reeling under the business losses and the other factors. But now they have ramped up, and as far as told in the beginning also, that localization has been focused in the JVs. So I think they should be able to maintain. But again, everything remains on the customer side, and also how the political conditions prevail across the globe. But there is no reason as of now that the JV should be going back to the losses.
Okay. I'll join back in the queue. Thank you.
Sure. Thank you.
Thank you. The next question is from the line of Radha from B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity and congratulations for good results. Sir, your capital employed in the consolidated business stands at 2,000 crores if we exclude the 130 crores of investment in Sundram Clayton. So this capital employed is including the working capital. So is it fair to assume that the company has invested out of this 2,000 crores, 600 crores is in the overseas business?
Rather, the investment in overseas business, the capital employed is 530 crores, 530, out of this 2,000 odd crores of capital employed.
Okay, sir. Thank you, sir. And are we investing any further in the overseas business in the next 2 years?
Well, that gradually we will see, because if you remember, in Romania, we were supposed to install 16 machines. We have done 5 machines as of now, but we are seeing how the business is ramping up in overseas. Basis that we will take a call, but right now the priority is to break even the operations over there. So right now we don't have any heavy CapEx plan in the overseas business.
Okay, sir. So secondly, the Sundram Clayton overall working capital cycle is almost double of Sandhar's working capital cycle. So when we integrate this wholesale plant from next year, so will this working capital cycle continue that they have, or do you think that it will be reduced to Sandhar levels?
So this working capital cycle you are telling from Sundram versus their customers, or how? Can you elaborate this?
Yes, I'm checking the Sundram Clayton overall business working capital cycle, since I will not be able to get separately for the wholesale plant.
Yeah, exactly, because Sundram has another business in Orgadam also. They call it a party business. So, but like we have acquired the Sundram, so any connection from Sundram is already over. They were the sellers and we were the buyers. Now our working capital cycle will be more or less from that business to our present profile.
Okay. And sir, just wanted to know, why did the current promoters sell this plant, and also a bit color on what kind of payback are you expecting? Is it fair to assume 15% ROC is a sustainable return ratio that we can expect from this business?
Yeah. So 163 crores we paid to acquire the business. This year we are expecting a revenue of 400 to 425 crores. And as you know, we keep a target of 2.5 to 3 times our asset turn in next 2 to 3 years of time that we will be scaling. And we remain confirmed to our ROC of 15% that we have discussed and mentioned in earlier also. But yes, that ROC will be coming in gradually over a period of time, but not immediately in this financial year.
Any color on why did the current promoter sell this plant, sir?
Yeah, so basically Sundram Clayton, again, they are integrating, or I would say they are exiting the non-core businesses. And this component zinc die casting, aluminum, LPDC, HPDC was not their core business. That's the reason, if you remember, see, they exit the plastic business also. So they are exiting the non-core businesses which they are not into. So the reason, to my understanding, is the same, that they want to continue their strategic and core businesses. That's the reason they are hiving off their non-core businesses.
Okay. And sir, out of the 180 and 200 crore CapEx plans that you have announced in this year, anything that how much would we be investing for this wholesale plant of Sandhar Clayton? And what is the overseas sales mix from this 400 crores?
So like around 200 crores of capex plan that I have said, we will be investing around 20 crores to 25 crores to upgrade the Sandhar Clayton lines once it is shifted to our premises. And it also excludes the 50 crores of the balance consideration that we have discharged in the month of April. Right. As far as overseas is concerned, as I told, we will be evaluating as and when required once the capacities are ramped up. The order base is expanded. Already we have in Romania 5 machines installed. In other operations, we are not seeking any heavy capacities over there except the maintenance and the very, very regulatory requirements. That's all.
No, my question was, this Sandhar Clayton wholesale plant, how much is the domestic sales and overseas sales?
It's a domestic sales only, sorry. I missed your question. It's a domestic sale only. We have acquired a domestic business. It's a domestic sale. There's no overseas sale from this plant.
And the customer would entirely be TVS?
We have an option. There's no non-competing clause. Right now it is TVS, but we can expand to any other customer base. And we, as far as LPDC is concerned, we are foraying into that business for the first time. So we have larger customer demands also for LPDC. We might cater to other customers also. That depends on future strategies, how we plan. But as of now, TVS is the main customer.
And so what parts does this plant make? And in terms of tonnage, you mentioned that one of the rationale is increase in tonnage. So what is the current capacity of the company in die casting and how much would it increase from this plant?
So that I'll get back to you because tonnage and those capacities I need to check with the business teams.
Okay. Thanks, I'll get back to you.
Sure.
Thank you. The next question is from the line of Saurabh Jain from Sunidhi. Please go ahead.
Hello. Yeah, good morning, sir, and congratulations for the good set of numbers. Sir, my question was to take it forward from the last participant on the CapEx. So you said 180 to 200 crores of CapEx for FY'26, and our maintenance CapEx, if I'm right, roughly around 160 to 170 crores. So there is no major plans for growth CapEx for FY'26, right? And this is in context of our current capacity utilization also. Capacity utilization for FY'25 vis-a-vis, including the upcoming ramp-ups possible in FY'26.
So first answering your capex, so like we are keeping a plan of close to 200 crores, more or less equal to our annual depreciation. Hello? Can you hear me?
Hello?
Hello? Hello?
Mr. Jain?
Hello?
Yeah. Can you hear me? Please?
Yes, sir, we can hear you.
All right. I think there's a disruption in his line there.
Should we move on to the next question, sir?
Yeah, definitely.
Mr. Jain, Saurabh, sir, I may request you to rejoin the question queue. The next question is from the line of Rajit Agarwal from Nilgiri Investment Managers. Please go ahead.
Good morning, sir. Sir, will it be possible to share the numbers for your overseas bills? What was the loss in Q4 and specifically the top line of Mexico plant?
So the losses, the console losses at the overseas on annual basis is 21.09 crores and fourth quarter is 3.74 crores. Sir.
Okay, thank you. And on Mexico specifically?
Mexico is close to 120 crores of annual revenue.
Okay. All right. Thank you, sir. And will it be possible to share some update on some of the products that you mentioned in Q3 that were delayed? For example, the mirrors for Hyundai and the SOPs are expected to begin in July, August. Are those timelines will the timelines still hold? And there were some new parts in sheet metal which were supposed to be launched in Q4 and the ongoing quarter of FY'26.
So this EC mirror EC mirror you are talking of for Hyundai?
Yes, sir. Yes, sir.
So Hyundai, the latest update is that by September they will be going for this. So there's a little bit delay of another, I think, 1.5 months. So September they have given us the revised date because they are working on the model in which they want to fix it. So that's the reason it's a delay from the OE side. Secondly, sheet metal, most of the new plants are already, because sheet metal is a continuous part development process and the models keeps on changing from the customer side. So it's a continuous development. So there is no, I would say, the closure or the opening date. It continues the part development, but the volumes are ramping up with the sheet metal. You can see we have registered a very good growth in sheet metal in this financial year compared to the last financial year. It's about 33% of growth that we expect, that we derived in sheet metal business. And it will continue with the growth momentum because the plants are scaling up. All the 3 plants are scaling up in Sandhar Engineering, and 1 plant is in Sandhar Technologies Limited, the parent company. All 4 are scaling up and giving us a good business.
Right. Thank you.
Thank you.
Thank you. The next question is from the line of Ankit from Adezi Ventures Family Office. Please go ahead.
Yeah, hi. Good morning. My first question is with regard to the current inventory situation with your clients. So is that lower or higher than usual? And how is the inventory for two-wheelers at the dealership level currently?
Can you come back on your question, please?
I didn't hear the question too well, please.
Yeah, I'm saying what is the current inventory situation like for at dealerships and with your clients? Is it lower or higher than usual?
Well, it's difficult for me to say. We know that there were some production issues, for example, at Hero, on account of some supply issues, and therefore their manufacturing and production went down in the last couple of months. But I understand they've started ramping up now according to the orders that we are getting. With the others, again, I would say from whatever news we have, of course, we have limited information compared to what FADA would have. But from whatever information we have, it is well within the range of the 45-day inventory target that most of these OEMs keep.
Understood. Thanks for that. And looking ahead for next year, what is the kind of revenue and EBITDA margin aspirations that you're looking at?
Yeah. So revenue, we are expecting a growth of around 14-15% in FY'25-26. And EBITDA margin, we have kept a target to go for further improvement by 30 bps to 40 bps basis.
What is our EBITDA margin number in that case?
Expectedly, if you add back, I think the figures can be derived now because we have closed a EBITDA of 10.20% on a console basis. So another adding 10.5 to 10.60. Roughly, it can be close to 470, 475 with our growth plans.
Understood. Thanks. And what is the key areas of confidence that take us to this higher growth and EBITDA margin for next year?
Yeah, sure. So if you see that in the last 3-4 years, we were investing heavily in setting up new greenfield and brownfield projects. Most of those plants have been commissioned and now they are scaling up the production. We are getting good responses from the customers. So going forward, there would be a neutralization of the fixed costs because the volumes will be increasing while the fixed costs will be remaining constant. So whatever the variable cost minus the prices will be coming, it will be adding up to our margin base. Secondly is that we have taken many of the the internal exercises to increase our operational efficiency as well to integrate some of the common operations also. So all these will be going to give us the desired results in this coming financial year as well as the succeeding financial years also.
Understood. Thanks for that. And finally, what has been the commodity cost outlook like and what is the outlook looking like for next year?
So, well, very difficult to project because commodity is something which is fluctuating, especially when the geopolitical situations are worsening. So, anytime sometime it just pops up with a higher trajectory. So, I think more or less it should be within the same range during what we have witnessed in the current financial year.
Currently, it's moving in a similar range to say last quarter?
Yeah. more or less, unless there is some massive change in the geopolitical conditions or the trade deals. That is a different situation there.
All right. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Saket Kapoor from Kapoor & Co. Please go ahead.
Yeah. Thank you, sir, for the opportunity again. Sir, you mentioned that for our overseas operations, we have made investment to the tune of 530 crore. Is that number correct, sir? The total
it's the capital employed, 530, yeah.
Okay. And sir, we posted revenue for FY'24 at 488 crore, and for FY'25 it is 452 crore. So there is a decline, and is this the number for which we have employed 530 crore as the capital employed?
So, looking to the last year's performance, you should not compare ideally, because last year has not been healthy. Everyone is seeing a fall in the overseas business, Europe and American markets. So I think the 1 year, single year's performance, we cannot benchmark it to the investment that we have done, because investments are always done with a larger perspective from long-term views. And the businesses keeps on, facing these cycles, I would say, the ups and down cycles. So last year was a down cycle, but the situation never remains the same. The coming year, succeeding years would be the better one. And you will see that the capital that we have employed does not go waste, and the plants will be generating a healthier top line as well as the bottom lines also.
So, sir, also on a conservative basis and taking things ahead, what should be the contribution from the overseas operation going at 2 to 3 years down the line, or is it very difficult to speak on the foreign operations because of the geopolitical situations as they stand today?
Yeah. So if you recall 2 years back, or I would say 1.5 years back itself, we were having a EBITDA margin of 13.5 above in the overseas business. And again, we plan to go back to the same levels. The geopolitical situations of that, like the tariffs and other things, I think they should be stabilizing, because all the countries are sitting together now to work out the trade deals. So sooner or later, they should be sorted out, and the operations would, this is all expectations depending on what the forecasts are coming. We expect the operations to go back to the earlier position and contributing a healthy margin base to our overall operations.
Okay. So since you alluded to this tariff part of the story, currently, sir, for our overseas operation, what are the current tariff trajectory and the proposed one for our overseas operations? What should the tariff look like?
So directly we are not hit out with the tariffs, because we have a pass on with the customers also. And so it's directly the country agnostic, how the country behaves between two countries. So directly there is no hit as far as overseas also concerned or domestic is concerned. But let's see how it works out and how the demand is there, and what are the preferences between the countries in terms of exports and exports. That we need to see after second quarter. I think by second quarter it should stabilize.
And just traditionally, we find the first half of Q1 to be the flat quarter in terms of the auto component, or the lean period is there for, or what should be penciling in terms of how the first half and the second half, the split between revenue works out?
So traditionally, first half is a little bit weak and second half is high, because second half is like festivals in India also, the demand is also there. So the revenue split normally is around, it's very difficult to say, but normally we see it around between 45 or 55 or 40 to 60. This is how the split is.
Okay. And lastly, sir, firstly, if you could also allude to us the current utilization levels, if that number could be explained, because we are into a lot of products, and so that penciling out on utilization levels might be difficult for both Indian and the overseas operation. And second point is that post our IPO in 2018, somehow investing community has not been able to, value creation has not happened. So have the management figure out or iron out the reasons for which the value creation journey has not happened for Sandhar in particular, and what steps can we expect going ahead that may create value for your investors at large going ahead?
So answering your first question, like in terms of capacity utilization, at one point of time, it is very difficult to say how all the businesses, because we have been adding the capacities, we have been modifying our basis, setup also. But like for sheet metals, the new plants, they are already above 70% now, right? As far as assembly lines are concerned, they work on a different pattern. So we don't have that much of idle capacity, if you say. We have available capacities also in which we can expand. So we plan out our operations basis that only, and we invest accordingly. Similarly, in the overseas, like 11 machines are pending to be deployed in Romania as per our initial plans. But again, we will be taking the call once we get the existing investment ramped up and the volumes increases. So that is a call that we take basis the demand and basis the available capacity. So if you really ask me whether we are overall basis 80, 70, so for different vertical, different plants, it's a different metrics altogether. But we keep the facilities with us, we keep the capacities with us because the customer demands keeps on fluctuating, and every time we can't go and start our expansion. So that's the reason it is a holistic view for next 2 to 3 years. We plan out our expansions also and the addition to CapEx also. As far as your another last part of the question is concerned, that post 2018 IPO Sandhar could not create value. So you see like there has been multiple reasons. One is that after 19 the auto industry again went into the back gear, and there was a degrowth in the auto industry. That was one of the reasons. Second, all of us know that the pandemic has hit globally. So 2 to 3 years were, I would say, they got washed off. Post IPO, you can say the timing of these all events that coincided with her IPO timing. But again, if you see last 3 years performance, we are back on the track. We have already moved to a double-digit margins, which the market was expecting, and I think our growth and improvement will continue. Now there seems to be no reasons as to we'll go back to the worst times, I would say.
Yes, sir. Thank you, sir. Can you comment on the credit rating, sir? When our credit ratings are due, and what is our current cost of funds?
So like our credit ratings are due next year now. We already done our ratings renewed from India Ratings as well as ICRA. And our average cost of borrowings, it lands something around, because the rates were comparatively higher, so it's roughly around 7.5% of the average rate of borrowing, including the movement in working capitals that we count. So we have got around 7.5% in between.
10.5% is our cost of fund?
Yeah, average, I would say. Not plain. It's the average cost of funds that we deploy.
Okay. And lastly, sir, you alluded to 200 crore capex for the current year. So, and what should be then our current maturities, and what should we like to close the year, although we are on the first quarter only, in terms of the closing debt numbers?
So I think in the earlier part of today's call, so I mentioned that this year we are expecting an improvement of 30 to 40 basis in our margins also. They will be sufficient enough to generate cash from operations. At the same time, we have planned for a 200 crores of capex, excluding the 50 crores that we have paid to Sundaram Clayton as a part of the final closure deal. So I think there should not be any reason that the debt should escalate in the normal for the organic business. So it should be within the levels what we are perceiving right now, within 850 crores of the levels. I think it should not breach. And we have sufficient cash flows to repay and honor our repayment commitments and schedules with the lenders.
Okay. And what are the current maturities for this year?
They are close to 100 crores. Yeah, it's 100 crores roughly this year.
Thank you, sir, and all the best to the team.
Thank you very much.
Thank you. Thank
you.
Thank you. The next question is from the line of Tushar Gupta from Sagun Capital. Please go ahead.
Thank you, sir, for giving me opportunity again. So I need one clarification that you have mentioned that 14 to 15% of revenue growth is excluding 400 to 425 crore from that subsidiary. Is that correct? So we can expect around 4,800 plus crore of revenue?
So like we have given 14-15% in between. Yes, you are right. It's excluding the Sundaram Clayton. That's another growth we can expect from the existing business. So basis that you can work out the figures, whatever it works out. And 400 to 425 is between the target we have set for Sundaram Clayton.
Sure. Thank you so much, sir. All the very best.
Thank you.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Well, all I want to do is thank the MK team and thank you all for your patience. We've tried to answer your questions to the best of our ability. But if anybody has anything more, you can write to the company and we'll be very happy to give you details of whatever you seek, whatever is possible within the domain of the law. We are very excited to see that the next year we are very bullish, and we hope that with everything the way it is and with the mitigation of the geopolitical scenario that exists, we will grow even further than our aspirations that we hold today. With that, I want to thank you all for your time and patience.
Thank you. On behalf of MK Global Financial Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.